Hello everyone. In this video, let us know about inflation accounting. So any idea what is inflation accounting and how and what are the methods we use in our inflation accounting? So what do you mean by inflation accounting? It is an accounting practice wherein the financial statement, what is there as our historical values, will be converted based upon our price level indexes. So inflation accounting is a practice wherein we adjust the financial statement according to the fluctuations of the prices, what is happening through our price level indexes. There are many methods of adjusting this particular inflation accounting and presenting the data, but the most three popular method which is there for this particular inflation accounting is current purchase price method, or it is also known as general purchasing power method. So popularly known as CPP or GPP method. Current cost accounting method, which is termed as CCA method, and the final one is a hybrid method, wherein it's a combination of both CPP as well as CCA method. So inflation accounting is nothing but we are going to prepare a financial statement having in account or in terms of price level changes, what would have happened over the years. Because in historical accounting, I would have recorded my land and building value as per what is purchased over 10 years back. But the same building and the land, if at all you're purchasing for your business, will be costing you high when after 10 years. So it is not right to write the values of 10 years before in our financial statement. So this inflation accounting came into picture wherein the price level indexes will be allocated with the values what is there in our financial statement, and a revised financial statement will be prepared. So in this particular inflation accounting, the first method or a technique what we have is current purchase power technique. So what do you mean by this particular current purchasing power technique? It is a method wherein various items of our financial statement which is there in our balance sheet and profit and loss account are adjusted with the help of recognizing the general price index. So based upon the general price index, the financial statement, that is a balance sheet and profit and loss account, will be revised. A consumer price index or a wholesale price index prepared by a Reserve Bank of India will be considered, and we are going to convert the historical cost, what is specified in our financial statement, and we are going to present a new profit and loss account as well as financial statement based upon the price level changes, what is prescribed by RBI. So what are the steps which is involved in our CPP method? So there are 7 steps which we follow under our CPP method. So first step, we need to know the information as per financial accounting statement should be known as per our historical records. That is nothing but the usual information what we have recorded in our financial statement is known as our historical accounting statements. So once we are knowing that historical account statement, step 2 says we need to classify the entire assets and liability of balance sheet as monetary items and non-monetary items. So what do you mean by monetary? So monetary is nothing but, if at all, the realizable value and payable value of your asset and liability will be same as a book value, then it is termed as monetary assets and liabilities. What is non-monetary then? Non-monetary asset and liabilities are those assets and liabilities wherein the realizable value as well as the payable value will be different from the book values. So for example, if at all I have written in my records the amount of debtors as 50,000, I will not get more than 50,000, neither less than 50,000. I know the amount what I realize from the debtors is 50,000. Same way, In under a liability side, if we have written any amount of loan, bank loan or debenture, my responsibility to pay will be the same amount what is reflected in our balance sheet. Whereas in case of non-monetary assets and liabilities, we are going to have a book values are different and realizable and payable value will be different. For example, if I have a stock, that stock, when I market that particular stock or when I sell that stock, it may realize more than the value what is written in a balance sheet, or it may even realize the lesser price. So now we will take certain items of balance sheet and we will check what's the reason behind that particular asset to be termed as monetary or non-monetary. So let us classify this particular assets and liabilities as monetary assets and liabilities, and we will check what are those monetary items and non-monetary items. If at all I term it as monetary, what's the reason behind terming it as monetary? If I term it as non-monetary, let us see the reason behind why it is termed as non-monetary items. So if you have cash in hand, all of you know it is termed as monetary item because the realizable value and the book value will be the same. If at all in my business, I have written as a cash balance in hand as 1 lakh rupees, I know that I have only 1 lakh with me. So it will not be increased or it will not be decreased. So the realizable value and the book value, what I have recorded in my books of accounts will be the same. For example, if you have 100 rupees with you, after 10 years also, the 100 rupees will be the same 100 rupees itself. It will be termed as you have 100 with you. So it will not be more, neither it will be less. But the buying power may differ, but the value remains the same, correct? So cash at bank also is termed as monetary because whatever balance we have in our bank, that is written in our books of accounts, and the amount what is as a balance which is reflected there will be your realizable value, correct? So realizable value as well as the book value is the same in case of our cash at bank as well as cash in hand. Building and land is termed as non-monetary because when I would have purchased my building 10 years back, I would have purchased it at a cost of 50,000 rupees. But after 10 years down the lane, same land and building, if you want to purchase, you have to pay more than 1 crore for the same land or a building which you would have purchased for your company. So land and building is termed as non-monetary because whenever you sell your land after certain years, the market value depends on the value of your realizability. So how much you realize on that land will be depending solely on the market value, not on your book values. So there is no guarantee that if you have written 50,000 of your building, you will realize the same 50,000 when you sell that building. So it might be more than 50,000 or it can be even less than that particular 50,000, correct? So land as well as building is termed as non-monetary assets. So next we will just check debtors. So debtors, I already told debtors is monetary because when I write my debtors amount, that is from my credit sales, if I have to get 50,000 rupees, I will neither get more nor less. So the realizable value as well as book value will be the same. Next is our creditors. So creditors is a monetary liability because the payable value and the book value will be the same. So for example, if I have written creditors for my credit purchases, what I have done for my raw materials, which I have used for my company, then I know the definite amount which is payable. The book value, what I have written, and the payable value will be the same at the time of liquidation or any time which you make your payment. Bank overdraft is also a monetary item because the payable value is fixed. Because if you have overdrawn your balance by 10,000 rupees, you're liable to pay only 10,000. And you know, if at all there is any interest charges what's a percentage of interest charged for that particular thing. So any kind of bank loan or bank overdraft is termed as monetary because we know the definite payable value and it will be the same as your book value. When it comes for equity share capital, so this equity share capital is termed as non-monetary because whenever I make a final payment for my shareholders, it purely depends upon the amount which is left over by the company. So you will not pay the equity shareholders same as the book values. It depends what is an amount which is left over at the time of liquidation, and the balance will be paid as a compensation for our equity shareholders. In case of debenture, debentures are termed as monetary because the payable value will be same as your book values and it is fixed value. So with a particular fixed percentage of interest, whatever you are liable to pay, you will be paying the same amount what is prescribed in your books. So this is a difference between your monetary items and non-monetary items. So in next video, we will check what are the other steps which are involved in our inflation accounting. Under CPP method, we have 7 steps which we follow for revising our new profit and loss account as well as our balance sheet. So the first step, I need to know the historical value. And the second step, what we have learned is classification of the entire assets and liability as monetary and non-monetary. Thank you all.